Hi guys, in this video we will look into an interesting option strategy. This is for people who have office during the day or busy with their work during the day and cannot look into the markets constantly. So the aim of this strategy would be that we would go for a very high probability of profit strategy, which in turn would give us very wide break-even points and a decent weekly profit. It's called a modified butterfly strategy. It's a simple strategy. So what we will do in this strategy is that we will buy at the money call and put debit spreads, and we will look to fund those debit spreads by selling far out of the money credit spread. So this is a simple Excel spreadsheet which I have prepared for calculation. So let's deep dive into constructing the strategy. So we will be constructing the strategy on Nifty option trades. Expiry would be the subsequent week expiry. So the current week expiry is 28 Jan. So we will be doing it for subsequent week expiry, which is 4th of Feb. What we will do is we'll first look at what is the current market price. So Nifty on Friday closed at 14,372 rupees. So we will take a strike price which is closer to that, which is 4,400. So these would be our buy strikes. So our buy strikes would be 14,400 call and 14,400 put. So to decide sell strikes, what we'll do is we'll choose say distance of 150 points away from our buy strikes. So these would be by default our sell strikes. So on the call side would be 14,450, or on put side would be 14,250. So the next step what we do is we go ahead and enter the option current market prices which are there, which is the last traded price. So 14,400 call is at 252.5, whereas 14,450 is at 178.15. Similarly, 14,400 put option is at 256.1, and 14,250 is 190.1. We will look to sell one lot of each, right? So the net debit on this debit trades is minus 139 rupees, which we get. So now what we do is we try and sell far out of the money credit spreads so that the net debit to credit should be as close to zero as possible. But what far out of the money credit spreads usually do we sell? So the way I do it is that I usually sell my sell strikes would be at least 100 to 150 points away from the one standard deviation strikes. How do we get to know the one standard deviation strikes? For example, uh, if I just if we just check, so 4th of Feb, say 14,400, our close current market price. So the one standard deviation strike prices is close to 15,000 on the upper side and 13,750 on the lower side. So we enter the same here. So our one standard deviation strike price is 15,000. Our one standard deviation lower strike price is 13,750. We will not sell these strike prices. We will further go out out of the money from these strike prices, say by 150 points. So I want to get far out of strike prices the moment. So I say 150 points from my one standard deviation. So my sell strike price now becomes 50,150 on the call side and 13,600 on the put side. So let's enter the last traded prices. 15,150 call strike is at 30 point. This is to 15,600 would be at 10 rupees. On the put side, 13,600 was trading at 38.25. This is last traded price, and 13,150. 13,150 strike price uh, is not very liquid and does not have any open interest. We will take the nearest strike price, so we will take 13,200. 13,200 trading at 11.15. Right now, to the quantity. So we will, since we will have to match this debit, right? We will have to keep adjusting this quantity so that, as I said, the net debit to credit is as close to zero. So if I start with one quantity of the credit spread, right, my net debit is 92 rupees. So I will increase my credit spread so that it keeps on funding, yet minus 45 rupees. So if I increase it to three lots, right, this gives me a net debit credit of 2.6, which is as close to zero. So this would be my ideal modified butterfly construction of the spreads. Right? So this would be my modified butterfly strategy. Now let's go and deploy this. Check what break evens are we getting. So I go back. I have already added the call. So first I will place the debit spread. So 14,400 and 14,550 is what we'll have to sell, right? Now on the put side, again, buying 14,400 and selling 14,050. Right? See, so these are our debit spreads. Debit spreads are those where if the market increases, we get profit. But if the market stays in range and we would incur a loss. So what currently now we do is, because we don't want this to happen, sorry, yeah, because we don't want this loss to happen, right, what we do is we try and fund these debit spreads by selling far out of the money credit spread. So how much do we sell? We sell three lots of this call side credit spread, which is 15,150, 15,600. So what we do is we switch back to call 15,150. We're selling three lots, yes, and 15,600. Similarly, on the put side, 13,600, right? We're selling three lots and buy 13, since 13,150 is not traded. We take the closer to 13,150, which is 13,205. So, so this is our spread. Now, if we come down and look, so if you look at the payoff diagram, you can see that this is the current strike price of Nifty, and the maximum profit is 11,445 on either side. And if one is to see the break evens here, so the upper side break even is 15,200 and the lower side break even is 13,550, which is roughly a spread of close to, so 500, 1,750 points. That's how the widespread is. And if you see the probability, so it has 81.2% probability of profit, right? Any trade which has more than 80% probability of profit is a very good trade to have. The maximum profit one can make is 11,445. Yes, the loss also would be very high, but because it's an 80% probability trade, 8 out of 10 trades would end up in profit. And in case Nifty moves very wildly into a loss zone, we will immediately cut our trade at maximum profit. So what I would suggest is that in case the loss reaches say 11,000, right, and that is when Nifty crosses 15,200 on the upper side, or crosses 13,000, or goes below 13,550 on the lower side, we have to try and put a max reward, risk to reward ratio is 1:1, and in case our max loss reaches 11,000, we cut the trade, right? So the estimated margin is 40,000 for this trade. Roughly the max profit is 4.8%. So this is how we deployed this trade, 81% probability and with a max loss of max profit of 11,000. Why I like this trade better than an Iron Condor trade is, so Iron Condor is nothing but, right, you take off the debit spreads and then you get an Iron Condor. Why I like this trade slightly better than Iron Condor is one, it gives a slightly higher profit. Second, the probability of profit is slightly better than Iron Condor with wider break-evens. So Iron Condor has a lesser probability of profit and smaller break-evens. So a modified butterfly one gives you a wider probability of profit range coupled with wider break-evens. Right? That's why I like this trade better. So this is called modified butterfly. This is for those who are usually busy during the day in their office work or any other work, and becomes difficult for them to actively manage during the day or during couple of days. One other thing to do is that, for example, if Nifty moves onto either side significantly, say if Nifty is going up either side and moves to say 14,800, 900, one can always roll up their put credit spreads closer and closer and then try and earn extra profit. Similarly, if Nifty goes below significantly, say 13,800, 900, one can always roll up their call credit spreads and benefit some extra profit from this. Hope you guys enjoyed this strategy. We'll be coming up with more interesting strategies in the coming weeks. Thanks for now. Cheers. Bye.